Hello, everyone. Thanks so much for joining us today. We have a very relevant and timely topic that we're going to be discussing, namely Safe Harbor 401k, making you the expert. So again, we are Ubiquity Retirement and Savings. My name is Chris Jasinski, and this is what we'll be talking about. So really getting into Safe Harbor and talking about how it's relevant for you as the advisor to your potential 401k clients. So without further ado, let's hop right into the agenda. We're going to talk a little bit about what is Safe Harbor, how it works, why it's important, and then obviously we'll be reviewing some of the key advantages to the participant and the plan sponsor, and then you as their advisor. So really going over what are some of the key reasons why people get Safe Harbor to begin with. We'll wrap up with some key deadlines for 2018. I'll give you a brief overview of Ubiquity and some next steps for contact information on how you can speak with us further. So many of you probably already have a sense of what a safe harbor match is in a 401k plan. But for those of you who don't, a safe harbor contribution is a sort of contribution that's made by the employer into a participant's 401k account. This amount is predetermined, normally represented as a percentage of the participant's salary. The most common form of a safe harbor contribution is a match, meaning the employer is only responsible for making a contribution when the employee does so. And we can see right here in the first section two common formulas that employers often choose from to determine their 401k plan safe harbor matching contribution, whether it's a dollar for dollar match on the employee deferrals up to 4% of their annual income, or another match, which is the dollar for dollar match up to 3%, and then 50 cents to the dollar on the next 2% of income for the employee's salary. You'll also see here that another option is what's called a non-elective contribution. And that's when a plan sponsor decides that they want to make a safe harbor contribution to the employee's account, regardless of whether or not the employee actually does so. So this brings us into a critical question. Because safe harbor contributions aren't a requirement for a 401k plan, why would a plan sponsor include a provision for a safe harbor match to begin with? This is an important point to address because it opens up the broader topic of how everyone benefits from a safe harbor. So let's start off with the employee. I think the advantages here are obvious. Number one, it's essentially free money that the employee's employer is depositing into their retirement account. Secondly, it can incentivize the employee to increase their savings rate. So let's say I'm an employee in a 401k plan, and I'm inclined to contribute only 2% of my salary to my 401k, but I know that my employer will match up to 4%. It's much more likely that I'll feel compelled to elevate my own contribution amount. One other key but unmentioned advantage for the employee is that these employer contributions are immediately vested. This means that as an employee, I'm always entitled to my employer's contributions immediately, and that they can't subject the receipt of this money to a vesting schedule. Now, a vesting schedule, for those of you who don't know, it's pretty common with profit sharing in 401k plans, where the employer can require that the employee works at the company for a certain period of time, be it 1, 2, or 3 years, before they're eligible to receive those profit-sharing contributions. With a safe harbor match, the employer isn't allowed to do so, and the employee gets access to that safe harbor money right away. So let's talk a little bit about as well the benefits to the employer and for you as the advisor. And there tends to be a bit of overlap here, so I'll talk about them in conjunction. The advantages for the employer that might not be as obvious, but they're pretty critical to know, especially when you're having these initial conversations with them. Firstly, when an employer has a safe harbor in their 401k plan, the most critical advantage is that they are automatically exempted from annual compliance testing that's required for all non-safe harbor 401k plans. This testing is essentially a government-mandated review of the plan, whose purpose is to ensure that the 401k plan itself isn't overly advantageous to highly compensated employees at the company. A highly compensated employee is generally someone who owns or has owned more than 5% of the interest at the business at any time during the year or preceding year, but also another definition of a highly compensated employee is an employee who made more than $120,000 in the previous year in their income. So this is a key point to know for testing season, because if the 401k plan doesn't have a safe harbor and it goes through that annual testing like all non-safe harbor 401ks are required to do, and those test results find that a given highly compensated employee's contributions for the year exceeded 2% of the average contribution rate of all non-highly compensated employees, then that highly compensated employee who overcontributed will have to take a mandatory distribution from their account, and that money of theirs will no longer be accruing in their retirement account. So this is pretty critical, because if I'm a highly compensated employee and let's say I want to contribute 10% of my salary to my 401k plan, well, if my employer decides not to have a safe harbor provision, that means the plan will go through testing. And if, for example, after that testing is conducted and it's found that all of the non-highly compensated employees only on average contributed 2% of their salary, well, my original 10% as a highly comped employee will be out of proportion and considered overly advantageous, and I'll have to take a kickback all the way down to 4%. In other words, getting it back in line with that 2% difference of the non-highly compensated employees. So suffice it to say, this process can be very frustrating for a highly compensated employee and the employer, and you are sure to hear about it if they hadn't expected it. So again, having a safe harbor prevents this testing from even needing to occur, really letting you and the employer breathe easy when it comes time to conduct that testing. Another key advantage for the employer is that any contributions they make on behalf of employees can actually be deducted from their corporate taxes. So this is an additional bonus for the employer if they're also a participant in the plan. They get to reduce their own personal tax liability with their own pre-tax contributions. They get to match those funds from their safe harbor match, and they get to use the figure from that safe harbor match for their own account to write off on their corporate taxes. So although we already briefly touched on it a few moments ago, another key piece to know for the advisor is that it really adds the additional peace of mind for you, saving you precious time and resources, whether it's coordinating back and forth with an employer or a highly compensated employee as to what's going to be happening with their money, talking with the provider as well. This can be a very complicated and arduous process that generally you as the advisor want to avoid to save you time and stress. So again, this is one of the key reasons why safe harbor can be very advantageous for you as the advisor. And then, lastly, one point that often gets overlooked is that when you have a safe harbor match, more employees are going to be saving, and those savings rates are going to be accumulating at a much faster rate, meaning it's ultimately going to boost the plan assets for you and your bottom line. So let's move on to some key deadlines for establishing a new safe harbor plan in 2018. This is very important to know because we're coming up on it. And if your client really wants to avoid discrimination testing in 2019, then they need to establish that safe harbor plan and distribute what's called the safe harbor notice, which Ubiquity provides, to their employees no later than October 1st, 2018. In other words, if your client sets up their 401k plan on October 2nd, their plan cannot be safe harbor for the remainder of 2018. Even if they plan to add safe harbor on January 1st, 2019, they will still be subject to compliance testing for the 3 months of 2018 where their plan was not covered by safe harbor. Since we at Ubiquity primarily deal with startup 401k plans, we tend to get a major influx of new clients close to the new safe harbor deadline. So we strongly recommend that your client establishes a plan with us no later than September 21st. But of course, it's never too early to begin these conversations with our plan design sales team, who is here to help you and your client through the evaluation process. Now, there are a number of different deadlines for existing 401k plans who are coming over to Ubiquity that might want to add or modify their safe harbor if they decide to come over to our low-cost platform. A good rule of thumb is to get them talking with our team no later than late August or early September, not just to account for the safe harbor notices, but also to keep in mind that it can take time to move assets from one provider to another, and for us to make sure we're getting their plan provisions right. So now moving on to just really briefly a little bit about Ubiquity. Really, we've been here since 1999, focusing on helping small businesses establish low-cost, digital-first retirement plans. And we've served well over 6,000 clients, 65,000 participants, and have overseen over $2.2 billion in assets. We really pride ourselves on competitive and transparent flat fee pricing for our clients and high quality service for all parties, whether it's the participant, the plan sponsor, or you as the advisor. We're also what's known as an open architecture record keeper, allowing you and your clients investment flexibility. Though that said, if you want to streamline things and you want someone else to be able to handle the bulk of the responsibility for the investment management, we also provide you and your clients access to a handful of 338 fiduciary investment managers. And that really allows you to streamline things for your micro market 401k offering, but also more critically helping you and your client mitigate fiduciary liability. So that concludes today's presentation. Please remember that it's never too early to speak with our plan consultant team to review your client situation. You can see my contact information here if you have any questions for me personally, or if you'd like me to introduce you to my retirement plan consultant team directly. Thanks so much and have a great day.